silver just fell double digits in a single month. And one of the biggest names in the bullion business says this isn't over yet. He's seen this pattern before, back in 2008, right before prices got cut in half. So is this a warning or a once-in-a-decade opportunity hiding in plain sight? What he says next might change how you look at your own savings. Welcome back to Currency Matrix, the channel built for viewers who want the facts, not the noise. Before we get into today's breakdown, take a moment and let us know in the comments where you're watching from tonight. It's always good to know who's on the other side of the screen. If you find value in what we cover here, we'd be honored if you'd consider subscribing. It helps this channel keep bringing you clear, honest analysis on the markets that matter to your future. Now, let's get into the story. Silver has always been a market of extremes, and this year proved it once again. Prices climbed all the way to $120 an ounce earlier in the year, a level almost no one expected to see so quickly. Then, just as fast as it rose, it began to fall. In the last 30 days alone, silver dropped around 20%. In just the last 7 days, it fell another 7%. For anyone watching closely, this kind of swing felt sudden and, for many, unsettling. To understand what happened, one bullion dealer offered some perspective. His name is James Anderson, and he works with Bullion, a well-known company in the precious metals industry. He has spent years watching how silver behaves, and he says this kind of sharp rise and fall is nothing new. In fact, he pointed back to 2008 as a clear example. Early that year, silver reached $21 an ounce. But by the end of that same year, it had fallen all the way down to $9. It was a massive drop, and it happened quickly. According to Anderson, silver rarely moves in a smooth, steady line. Instead, it tends to move in sharp bursts. It climbs fast, pulls back, climbs again, and sometimes falls hard before finding its footing. This year followed a similar pattern. The breakout point was around $54. From there, the price pulled back to $46, then pushed forward again to $54. After that, it surged all the way to $120 in just a few months. Now, the prices returned close to where that breakout began, sitting near $54 or $55 an ounce. Anderson explained that this kind of rapid climb is often unsustainable. When a price rises too quickly, it tends to attract a wave of new buyers who jump in late, hoping to catch the momentum. Many of these buyers use borrowed money, known as leverage, to increase their potential profits. But leverage cuts both ways. When the price turns and starts falling, those same buyers can lose money just as fast as they gained it. Anderson described this pattern as something that happens often in financial markets. Large amounts of money flow in quickly, driven by excitement and fear of missing out, and then just as quickly, the market corrects itself. He also pointed out that this was not just about small investors buying coins at a local shop. Larger financial players, including hedge funds, were involved as well. When trading activity and leverage in the market grow to extreme levels, it often signals that a pullback may be coming. Anderson suggested that some of the people trading with heavy borrowed money on the way up were the ones who suffered the most once prices reversed. Still, he was careful to add some balance to the picture. He explained that anyone who bought silver at much higher prices, especially near the peak, likely feels frustrated right now. But he reminded viewers that physical precious metals are generally not meant for short-term trading. People who buy gold and silver in physical form are usually thinking in terms of years, not days or weeks. A drop like this, while painful in the short term, does not necessarily change the long-term outlook for people holding physical metal. The sharp rise and fall also raises bigger questions. Why did silver rise so fast in the first place? What role did large-scale buying and selling play? And most importantly, what happens next? These are the very questions this story will explore. Right now, the physical silver market is behaving very differently from what many people might expect. According to bullion dealer James Anderson of Bullion, one of the biggest shifts is on the selling side. Sellers have almost disappeared. During the run-up toward $120 an ounce, a large number of people rushed to sell their silver, cashing in on the high prices. Coins, bars, and rounds moved out of private hands and into dealer inventories in huge amounts. But now that prices have dropped back down, that flow has slowed to a trickle. Anderson explained the simple reason behind this. Very few people want to sell silver at today's lower price unless they are truly desperate for cash. Selling now, near $55 an ounce, feels like a loss compared to recent highs. Because of this, dealers are seeing their secondary supply dry up. Over time, this means dealers will need to turn to wholesale markets to restock their shelves, rather than relying on everyday customers selling silver back to them. One number that keeps coming up in these conversations is $50 an ounce. Anderson called this a psychological floor for the market. It is a round number that almost everyone in the industry recognizes and watches closely. He said it would be surprising to see silver fall much below that level under normal conditions. It is possible, he noted, that a brief dip below $50 could happen if there were some kind of sudden deflationary shock in the broader economy. But under the current environment, with policymakers focused on supporting financial markets ahead of upcoming elections, a deep and lasting drop below that number seems unlikely. Anderson also addressed what could happen if silver did briefly slip under $50. He believes many long-term buyers, the kind of people who have been steadily building their silver holdings for years, would move quickly to take advantage of such a dip. These buyers often keep cash ready specifically for moments like this. If the price fell sharply, he expects a wave of buying to follow almost immediately, which would help absorb available inventory and support the price. As for right now, Anderson said current inventory levels at the dealer level remain healthy. There is no reason, in his view, for buyers to worry about shortages or sudden price premiums on popular products like Silver Eagles. However, he pointed out that experiences can vary depending on which local shop someone visits. Some smaller dealers who purchased their inventory at higher prices may be hesitant to sell it at today's lower spot price. This can lead to noticeable differences in pricing from one shop to another, even on the very same day. Another detail that matters to many buyers involves sales tax. In most states across the country, physical silver and gold purchases are not subject to sales tax. However, a handful of states do apply one, and Washington recently became one of them. Anderson noted that when a state adds this kind of tax, it often changes buying behavior. Some residents choose to purchase their metals from sellers in other states, or arrange for purchases to be shipped to a different address altogether, simply to avoid the added cost. He described this as a common and predictable response whenever a new tax appears. Anderson estimated that roughly 40 states currently have no local tax on precious metals purchases, and he sees the overall trend moving in a favorable direction for buyers. Still, in the small number of states that do apply these taxes, he believes a significant portion of regular buyers actively look for ways around them, viewing it as a reasonable response to what he considers an outdated practice. Taken together, these current market conditions paint a picture of a market that is cautious but not panicked. Supply is tightening slightly, prices remain anchored near meaningful psychological levels, and buyers continue adjusting their habits based on cost and convenience. Behind every sharp price swing in the silver market, there are real consequences that ripple far beyond the numbers on a screen. According to bullion dealer James Anderson of SD Bullion, one of the biggest factors behind this recent crash was the heavy use of leverage by short-term traders. As silver surged toward $120 an ounce, many traders borrowed money to increase the size of their positions, hoping to multiply their gains. This strategy can work well when prices are rising. But when the market turns, those same traders often face losses far larger than what they originally invested. Anderson described this pattern as something that shows up again and again across financial markets. Large amounts of fast-moving money enter a market during a rally, driven by excitement and fear of missing out. Once trading activity and borrowed money reach extreme levels, the conditions are often set for a sharp reversal. He explained that certain large players in the financial industry specifically watch for these moments, entering the market to take advantage once over-leveraged traders are forced to sell. For everyday investors without deep market experience, this dynamic can be difficult to see coming, and even harder to avoid once it begins. Beyond leverage, there is a much bigger global story shaping silver's future. Anderson pointed out that silver is not simply a domestic market driven by decisions made in one country. It is a truly global commodity, with strong influence coming from regions like India and China. In India, recent changes to import duties on silver were introduced to help protect the country's currency. While this reduced how much silver flowed into the country, it also created a side effect. Local silver inventory within India has started shrinking, and prices there have climbed to levels far above the global spot price, reportedly nearing $80 an ounce in some local markets. This kind of imbalance matters because it reflects a larger tug-of-war between Western and Eastern demand. Anderson explained that historical data going back more than 5 decades shows a repeating pattern. Supply and demand between these two halves of the world tend to fall out of balance over time, creating what he called a structural deficit. Eventually, this imbalance forces the market to correct itself, often through a significant rise in price needed to bring supply and demand back into balance. He noted that this kind of major market clearing event has happened roughly 5 times in the last 55 years, and he believes another one may be on the horizon within the coming decade. These consequences are not just theoretical numbers for economists to debate. They affect real people, making real financial decisions. For those holding physical silver with a long-term view, short-term price swings like this one may feel uncomfortable, but they do not necessarily change the underlying reasons someone chose to hold the metal in the first place. For short-term traders using leverage, however, the consequences can be immediate and severe, sometimes wiping out significant portions of their investment in a matter of weeks. There's also a broader economic angle worth considering. Anderson connected today's environment to the lasting effects of a fully fiat or paper-based currency system that has existed since the early 1970s. In his view, this system creates long-term pressure that pushes some investors toward physical assets like gold and silver as a form of protection. Whether someone agrees with that view or not, it represents one perspective shaping demand in this market, alongside more immediate factors like interest rates, election year policy decisions, and global trade tensions. Taken together, these consequences show that silver's recent crash is not an isolated event. It connects to decisions being made by traders using borrowed money, policies being set in countries like India, and much older patterns tied to how the world's financial system operates. For viewers of Currency Matrix, understanding these deeper forces offers a clearer picture than simply watching the price go up or down day to day. As this story continues to develop, many viewers are left asking the same question: what happens next for silver? According to bullion dealer James Anderson of SD Bullion, no one can predict the exact path with certainty, but history offers some useful clues. He pointed out that silver started this year trading around $80 an ounce before its dramatic run to $120. Given that pattern, he suggested it is entirely possible for silver to fight its way back toward that $70 to $80 range by the end of the year, even after this sharp pullback. Anderson was careful to note that this is not a guarantee. He explained that anyone trading with a short time frame, especially those using borrowed money, should be prepared for the possibility that this recovery may not happen quickly. For traders working within a 6-month window, he suggested being ready to manage losses if the market does not move the way they expect. This is very different advice than what he offers to long-term holders, who he believes are better positioned to simply wait out short-term volatility. Looking further ahead, Anderson raised the idea of a much bigger shift over the coming decade. He referenced historical patterns, showing that silver markets tend to experience major clearing events roughly once every 10 years, where structural imbalances between supply and demand force prices sharply higher. Based on this pattern, he estimated that a future clearing event could eventually push silver prices into the multiple hundreds of dollars per ounce range, though he was clear that this is a long-term projection, not something expected to happen immediately. For viewers watching this unfold, there are some practical questions worth considering. Are current price levels seen as an opportunity or a warning sign? Is now the right time to reassess a long-term financial strategy, or simply a moment to observe and wait? Everyone's financial situation is different, and there is no single right answer that applies to all viewers equally. Anderson also emphasized the importance of thinking beyond short-term price swings. He explained that physical precious metals are generally best suited for people with a long-term outlook, often spanning 5, 10, or even 20 years. For those viewers, a 30 or 40% price swing within a single year, while dramatic, may matter far less than the metal's role within a broader long-term financial plan. Staying informed remains one of the most valuable steps any viewer can take moving forward. Watching how major economies like India and China respond to changing import rules, tracking interest rate decisions, and paying attention to how leverage builds up in the futures market are all useful ways to understand where silver might be headed next. Official data from organizations that track global silver supply and demand can also help separate short-term noise from long-term trends. There are also upcoming events worth watching closely. India's wedding and holiday season typically increases silver demand later this year, and any further changes to import policies there could influence global prices. Election-related economic policy decisions in the months ahead may also play a role in shaping investor sentiment toward precious metals more broadly. As this story continues, one thing remains clear. Silver has always been a market defined by sharp moves, strong opinions, and long-term significance for those who choose to hold it. Whether this recent crash marks the beginning of a slow rebuild, or simply another chapter in a much longer cycle, only time will tell. For everyone watching tonight, this moment is a reminder of why understanding the full picture matters, not just the headlines. Markets rise, markets fall, but the reasons behind those moves are what truly help people make informed decisions about their own financial future. Thank you for spending this time with Currency Matrix. If this story helped bring some clarity to a confusing week in the markets, consider sharing it with someone who might find it useful too. Until next time, stay informed, stay grounded, and stay ahead of the headlines.